Hello, and welcome to the Freddie Mac Connect Creative Solutions for Foreclosures and Other Liquidations session. Audience members are in listen-only mode. This session is being recorded and will be available following the conference. To submit a question, please use the Q&A box at the bottom of your screen. If you are experiencing any technical issues, please use the Q&A box and someone will assist you. Lastly, you will find icons at the bottom of your screen with links to the speaker bios and the presentation deck. With that, I will turn it over to our speakers, Marketing Program Management Business Lead Donna Bent and Loss Mitigation Senior Manager Delouise Brown-Milner.
Thank you, Talia. Thank you for joining us and for coming to Freddie Connect 2022. What a great opportunity to be able to learn about what's going on at Freddie Mac, but also to be able to network with some of your compadres in the industry. So let's go through what our agenda is today, because the session is creative solutions. We're going to start out by talking about then versus now, kind of pre-COVID or during COVID, and what are we looking at now? We're also going to talk about housing market impacts to liquidations and foreclosures. How does the current market affect those things? We'll go through some delinquency solutions. Then we're going to talk about litigation and foreclosure strategies. And then at the very end, now what, right? So if we want to do some grounding, I want to kind of set stage for our conversation. These are some basic statistics, and you can see they were kind of mid third quarter 2022. They are not Freddie specific statistics, so they're kind of industry wide. But if you just look at it, 3.7% unemployment, third quarter-ish, versus April 2020 was 14.7. Now our 30-year interest rate is upwards of 6%. Back in March of 2020 is 3.6. And our delinquency rate, April of 2020 was 8.22, and that was going into COVID with beginning those forbearances. And now the delinquency rate is down at 3.64. So I am not an economist. For real market information, make sure you attend the session at Freddie Connect that includes the economy, the update from our economist. But these numbers actually, compared to early 2020 when COVID was beginning, they really represent categories that impact our business. In general, they remind us that there is work to do and there's opportunity to be specific about the strategies that we employ. In this session, we're going to review strategies on how to adjust to the current market, how to address delinquencies, first from the perspective of avoiding foreclosure, then from the perspective of liquidating efficiently, including foreclosure. If you attended the foreclosure session last year at Freddie's Connect, that was me, and you heard a message with some uncertainty and a few concerns about the future state, that we're really not seeing as much as we anticipated. We thought there would be huge court delays coming out of the pandemic, high bankruptcies, maybe a lot of contested foreclosures, and we're not really experiencing that yet. But let's hear what Delouise has to say about the current trends as it relates to liquidation and foreclosures.
Thank you, Donna. Post-moratorium, we saw a cautious return by both servicers and law firms. Compared to volumes pre-moratorium, we noticed that our volumes are down approximately 30% this year for foreclosure activity. And if we compared that back to the peak of the financial crisis back in 2009, our foreclosure activity is down by approximately 96%. On this slide, you would notice some industry data. The trends that we are seeing is very much in keeping with what we're seeing happening in the rest of the industry. So what's causing this decline in activity post-moratorium? We believe there are a couple factors that are feeding into it. One, we're operating in a highly regulated environment. Both servicers and law firms took additional time to ensure that files were completely vetted for loss mitigation prior to proceeding with foreclosure activity. The second reason that we're noticing this decline is due to the threat of higher litigation, particularly litigation from debtor's attorney or borrower's counsel. They're looking closely to see if there are any errors in foreclosure processing, as well as the potential to miss any of the regulations that are required both by servicers and by law firms. We're also in an environment where borrowers had lots of loss mitigation options available to them. There was lengthy forbearance periods that were available to borrowers, many of those forbearances extending out to 18 months. There were favorable economic conditions as well, very low interest rates, increased property values. Borrowers had the flexibility to not only pursue loss mitigation with their servicers traditionally, but they also had the flexibility to refinance into more favorable terms, to sell their property, or to take cash out to resolve the delinquencies. On the next slide, I'm also sharing some additional industry data. On this particular slide, it's a comparison of the first months of 2022 compared to prior years. You would notice that for 2022, the first months, it appears to look similar to foreclosure activity in 2019. The first 3 months of the year, we did see a slight uptick, but that uptick in activity was mostly around the resumption of foreclosures that were placed on hold for the duration of the moratorium. We did see some new referral activity, and we believe those were sort of just pent up and being held by most of our servicers from the fourth quarter of 2021. Beginning in March, going into April, we began to see a slight decrease in foreclosure referrals. And we believe the reason for this is borrowers are exiting a lot of the lengthy forbearance that was allowed to them and now seeking permanent loss mitigation alternatives. In addition to that, some borrowers are even seeking additional assistance through mortgage assistance fund programs, such as HAF. HAF is the Homeowners Assistance Fund. It's a federal program that's implemented on a state level. Several states, we understand, had some delays in implementing their programs, not until the second quarter. We believe, however, that we could see an uptick in volume due to the current economic conditions. We now have higher interest rates. We are seeing some softening of property values. All of these factors could create less opportunities for borrowers to resolve their delinquencies. So this is just a snapshot of what we're seeing at this time. But again, that outlook can change. Post-moratorium, these are the states where we're seeing the higher foreclosure volumes. Those states include Georgia, Florida, Indiana, South Carolina, Ohio, to name a few. One thing that stands out when you look at what states have the higher volume is that these states, most of them are judicial foreclosure timeline states. In these states, it usually takes longer to complete a foreclosure process. We're watching closely to see if there will be any extended foreclosure timelines as a result of these courts trying to balance the loans that were previously in foreclosure, where foreclosure was resumed post-moratorium, as well as the new volumes that we're seeing in the state. The challenges for this crisis is not going to be a crisis of foreclosure volume like we saw in 2008 and 2009. We really believe the challenge for this crisis would be monitoring delays and navigating any of the regulatory requirements that did not exist in the last crisis. So let's talk about some of the delays that we're seeing. There are numerous delays that can be contributed to loss mitigation attempts. Those loss mitigation attempts include HALF, which I mentioned previously was the federal program that's being implemented on a state level. We're also hearing from some servicers that borrowers had some confusion around forbearances versus forgiveness of debt. So they're working through some of that portfolio just to ensure that the borrowers are fully aware of what programs are available to them post forbearance. We're seeing court delays in some states, but as Donna noted, not on the wide spectrum as we predicted last year, but we are seeing some court delays. We're also seeing an increase in probate. There are definitely solutions for these files, and we want you to reach out to us on any issues resolving probate. We are seeing increases in that area. Now, some historical delays have continued post-moratorium. So unresolved title issues, litigation, and bankruptcies continue to be some of the delays that we're dealing with post-moratorium. Now that I've given you some insight on our foreclosure landscape post-moratorium, I will hand it back to Donna so she can begin our discussion around solutions. Donna?
Thank you, Deloise. That was really helpful. So we are going to start talking about delinquency solutions at this point. And as you look at the screen ahead of you, the first thing I want you to notice is forbearance activity. Now, this again is not just Freddie specific. This is data that's put out by Black Knight. And if you notice that top chart, it tells us that in August there were 30,000 loans, GSE, still in forbearance. So that's work to do, right? But then if you, I'm sorry, not 30,000, and I can't even read the number. 111? But there are 30,000 loans coming off of forbearance this month, November. And that is a population that immediately we need to get a hold of. We need to immediately step in and strategically work with those borrowers on the solution to delinquency. So I'm sure these numbers are not a surprise to you when you look at your own portfolio and those that you service. Analysis shows that around 20% of borrowers who have left COVID forbearance are not in any kind of loss mitigation plan with their servicers. Let that sink in for a minute. 20%. Again, what that does is puts us in a unique position to employ creative strategies, both for retention and liquidation. So let's start with retention. Retention first, right? If a borrower is eligible and able, we want to do what we can to keep them in their property. And the population of borrowers who have expiring forbearances and the population where there is currently no active loss mitigation really defines the work ahead of us. There are other reinstatement and relief options, including repayment plans, that you would consider first. But if a borrower has been on a forbearance for 18 months, a repayment plan is probably not going to be the best solution for them, right? So if you can't do a repayment plan, or the borrower doesn't have the ability to reinstate or partially reinstate, then you'll look to our payment deferral, our COVID-19 payment deferral. And I really, you guys are going to think this is corny, but I really think it is the best thing since sliced bread. It basically returns the borrower to normal pre-COVID payments. There is no trial period. Once the borrower agrees and you approve it, as soon as the following month, the borrower can begin making contractual payments. The deferred delinquency will be due when the loan pays off. The term is not extended and the interest rate remains unchanged, which in today's climate, that's a pretty good deal, right? So if a payment deferral isn't a solution for the borrower, if they really do need some kind of payment relief, then we look to the flex modification. Now you're going to be familiar with the flex modification. It's a program that you know, right? And we know that many borrowers are not in the same position coming out of COVID as they were prior to COVID. So with the streamline component of the flex modification, you really have the opportunity to pursue those no contact borrowers, maybe some of those who have forbearances expiring in November where we've lost track of them. But you're familiar with our flex mod program. It does have a trial period. We are doing our best to target that payment reduction of 20% or greater. The delinquencies, including escrow, are capitalized. The term is extended to 480 months. Now, we know some borrowers are not really happy about that, but it's really not a difficult conversation because express to the borrower that we are making the loan affordable for them at this point, meeting them where they are at this point. And when they get in a better position financially, then they can make extra payments and pay it down early. The flex mod could provide interest rate relief, but probably not right now, not in most cases. And there also could be principal forbearance as a result. So because you are familiar with our flex mod program, and some of you are probably thinking, you know, it's going to be really difficult to achieve that. What if the required terms can't be achieved? Well, this is where the better together comes in, right? This is the theme of the conference. So what we're asking you to do is make a recommendation to Freddie Mac in Workout Prospector, and you're going to include the borrower's hardship, the borrower's income at a minimum, and it's likely with many of these loans, you're not going to have a borrower response package because it's not required because of the delinquency, but we still need to know what to base a decision on, right? What to base affordability on. We also are going to want your contact information. Now, what we're asking you to think about here is what can the borrower reasonably afford? Let me give an example. What if the borrower, maybe they can afford, when you run the numbers, a mortgage payment of $1,800 a month. But when you do the flex mod calculation, the best it comes out with is $2,000. Well, we know the borrower can't afford $2,000, right? How can we get to that number? There are several components of that calculation. So we're asking you to evaluate what can the borrower afford and then send recommendations to Freddie Mac. What that will do for sure is get the conversation started and help us work together to find the best solution for that borrower. Now, here is a prime example of where we have been better together. This is a real scenario, and this is an example of where we used a retention strategy to resolve liquidation. So Mr. and Mrs. Smith alleged improper servicing by servicer A, alleging that they were not given sufficient time to pursue a foreclosure alternative prior to being referred to foreclosure in 2017. So this is before COVID and before we even dreamed about COVID, right? Soon after the foreclosure referral, the borrowers alleged that they made several attempts to seek loss mitigation and were told that their file had transferred to servicer B. They alleged that servicer B was also not responsive to their efforts, and they filed a wrongful foreclosure action naming servicer A and servicer B. In the action, they also challenged the severity of the delinquency. The state was New York. We were looking ahead to an additional 3.5 years of foreclosure effort, knowing that the borrower is contesting it, right? So what happened with this, the better together solution? The servicer reviewed the loan for loan modification. The payment didn't provide sufficient relief, so it was escalated to Freddie Mac with a recommendation to consider a loan modification outside of the normal delegation or normal program terms. The solution? We approved an exception loan modification. It allowed the borrowers to keep the home, which resolved the ongoing litigation and foreclosure action. So in this case, not only were we better together, but it was a win, 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 win. It was a win for the borrower, a win for Freddie Mac, a win for servicer A, and a win for servicer B. So what we've been addressing is retention. But retention isn't always possible. So now we're going to talk about loss mitigation liquidations, but we're also going to talk about liquidations as a strategy for resolving problem files. Per Black Knight, second quarter of 2022 posted the lowest negative equity on record, with fewer than 0.5% of all mortgage holders owing more than their home's current value. That's significant. That means fewer than 0.5% of all mortgage holders are underwater. That's terrific, right? It's a great market. It's strong values for the properties, which means it's not a great market for short sales, typically, right? But as the market shifts and home appreciation slows, and Deloise even made reference to we're seeing a softening in values, and appreciation or values might even begin declining. What we know is that the borrowers who are most at risk of ending up underwater are those who originated their mortgages in 2021 and 2022. Interest rates were so low and values were so high, it's very likely that a lot of borrowers kind of overpurchased, right? Well, how does that translate into liquidations as a solution to delinquency? Well, if we think about loss mitigation, then we have the opportunity to think about our streamlined short sale and streamlined deed in lieu programs. And these can really be applied for borrowers who fit any of the criteria that you see on your screen. What that really means, because it's streamlined, is that you don't have to collect a borrower response package, and you can determine eligibility using data that you already have. For example, you know if the borrower failed a trial period in the 12 months prior to the time you're reviewing it. You know if the borrower became 60 or more days delinquent in the 12 months following a completed modification. You also know if the borrower has had 3 or more modifications. And then the one that's highlighted with an arrow, you also know if the borrower was on a forbearance and became 90 or more days delinquent due to COVID or a disaster. You also maybe have this information where the borrower's credit score is less than or equal to 620 and the mortgage is not secured by an investment property. So you have the opportunity to evaluate your portfolio and strategically reach out to these borrowers. But you can also think about short sale in terms of a creative way to work with a borrower to settle complicated property issues or long-term litigation. Again, the power of two. So strategic liquidation, think about it that way. What if there's risk of property ownership? What about litigation that could affect a successful foreclosure? What about if the property is seriously deteriorated and there's a buyer for the property? And there is a cash for keys opportunity sometimes to entice a borrower to cooperate with a deed in lieu of foreclosure. Even if the borrower occupies the property, Freddie Mac will help with relocation incentives. Maybe sometimes cash for keys and a little bit of cash to help them make a deposit on their next residence is the motivation that a borrower needs. So Deloise really is going to touch on this in a few minutes. But your challenge is this: develop a strategy to reach out to these borrowers. Look at your troubled loan population and reach out to these borrowers and help them understand these options as solutions. So liquidation really is just broader than short sale or deed in lieu of foreclosure. It is also foreclosure. And there's strategy and flexibility in how you go about the process. And Deloise is going to take some time to share that with us.
Thank you, Donna. Those were great strategies. And at this time, let's talk a little more about litigation and some additional strategies that we can use in the foreclosure space. The biggest delay to our foreclosure timelines, besides bankruptcy, is litigation. Litigation delays our timelines up to almost 5 years. In this segment, we'll start the discussion by distinguishing the two types of litigation as described by our Freddie Mac Seller Servicer Guide. Then we will talk about the role that servicers, law firms, and Freddie Mac can play so that we can work together to resolve these loans. And then I will provide you some information on strategies and how you can best contact Freddie Mac to discuss these loans for some type of loss mitigation solution. So there are two types of litigation as defined by our Freddie Mac Seller Servicer Guide. The first category is referred to as non-routine litigation. These actions usually present cases where Freddie Mac is named. There is an issue that might pose a significant legal, financial, or reputation risk to Freddie Mac. The case might actually involve all of those three risks. There could be actions where the party is seeking a monetary relief against Freddie Mac, or they're challenging the validity or priority of our lien. Any impact to our interest in an REO or real estate owned property is also considered non-routine. Now, this is not an exhaustive list of all non-routine issues. This is just a reference, so you can begin to distinguish between cases such as these that provide a heightened risk to Freddie Mac versus the other category of litigated loans. All non-routine issues should be sent to our legal department. and they can be contacted via the non-routine litigation email box. I have also included for you 2 guide sections where you can have a deeper understanding on what constitutes a non-routine action. Those guide sections are 8601.24 as well as guide section 9402.2. The second category of litigation is referred to as routine litigation. In these cases, Freddie Mac is not usually named. The allegations are usually case specific, and even if the borrower was successful with the defenses raised, with the allegations raised, the negative legal exposure would not create a precedent beyond the specific file. These types of issues often arise from some misunderstanding between the borrower and the servicer. Some examples of routine actions would include challenging a foreclosure process. Another example would be challenging the severity of the delinquency, as well as misunderstandings over loss mitigation and what that borrower's role was in securing the loss mitigation outcome. These issues are handled by the foreclosure team. The foreclosure team can be reached at the foreclosures@freddiemac.com email address. Again, here is a guide section giving you more of a deeper discussion on routine versus non-routine, sections 9402.2. Interestingly, most of the litigated issues that we see at Freddie Mac fit into this category, routine actions. They should not be treated lightly because cumulatively they can create a huge cost exposure as well as a timely exercise for our law firms as well as our servicers. So these loans should be monitored very closely. The good news is that there are options in resolving both litigated routine as well as non-routine. Here are some best practices for you. Always submit litigation resolution recommendations to Freddie Mac. Please provide as much information as you can on the case, as well as any information to support your recommendation. You should also contact your foreclosure and bankruptcy representative. There is a foreclosure and bankruptcy representative for every size of portfolio. They're standing by to engage with you and have those loan level conversations to resolve these loans. Reporting accurately. Freddie Mac requires both servicers as well as law firms to report timely and accurately. So a best practice is to ensure is that we're getting correct reporting on these loans. So litigation strategies. On this slide, I provided some questions that could start the conversation between Freddie Mac and the servicer or between the law firm and Freddie Mac in helping to determine what type of resolution we can provide on a litigated file. We always want to know, what does the borrower want? That question helps us to determine if we're looking at a retention solution, similarly to the ones that Donna provided, or if we're looking at a liquidation option. When loans are litigated, Often you will require Freddie Mac's approval. So these cases would need to be submitted to Freddie Mac and reviewed on a case-by-case basis. Can we reasonably give the borrower what they want? Sometimes it's possible, sometimes it's not, but we still recommend that you submit the recommendation, and often we can negotiate terms that would be best for all parties involved. Also very important for us to know is how much have we spent so far on the litigated action? How much do you propose that we will continue to spend on the action? Is there any merit to the borrower's case? What state is the property located in? And are there any risk of ownership issues? All of these questions, again, help us to begin the conversation in finding the correct solution for these files. These should be sent to the foreclosures@freddiemac.com email address. So here is just a visual reminder or a prompt when you're thinking about litigated files. If the borrower wants the property, then we will consider retention options. Some examples of retention options would be alternative or special terms for a loan modification. If the borrower does not want the property, then we're looking at the liquidation path, very similar to what Donna outlined, but many times we're giving exception terms to what currently exists in our guide. Again, it's a case-by-case review, and these types of approvals would require Freddie Mac's review and approval. Here is an example where we worked together, servicers, the law firm, as well as for the benefit of the borrower, to find a strategy to resolve a litigated file. And this is a liquidation strategy compared to the retention strategy that Donna provided. We'll call our borrower Mr. Brown. So Mr. Brown was contesting his foreclosure since 2018. This is also prior to the COVID moratorium. He made several claims, and each of his claims were found to be without merit. However, lots of time has been spent, a lot of time lapsed, and it was costly to continue to litigate this file. The borrower was not responsive to any attempts for retention opportunities by the servicer. His property is in Illinois, and we anticipated that the foreclosure action would be litigated for at least another 2 years. The file was escalated for a loan level discussion at Freddie Mac due to the aging of the file. We were able to recommend a liquidation strategy be offered to the borrower and borrower's counsel. The borrower accepted the strategy that was presented, since we uncovered that his interest really was not actively participating in any form of loss mitigation, whether it was retention or a liquidation strategy such as a deed in lieu. He really wanted to exit the property so that he could relocate to the state of California to find employment. We were able to work with Mr. Brown on a consent to the foreclosure judgment, and in turn, we gave him an exception, cash for keys. This allowed for a graceful exit from the home for the borrower. It was a win for the borrower. It was also a win for Freddie Mac, the servicer, and the law firm because we were able to resolve the aging on this file. By signing the consent judgment, that property came immediately into our REO. We would like you to think about a time where you used a creative solution to resolve liquidation. If you could place that scenario in the chat, we would really like to hear how you used creative ideas to resolve aged and litigated files. At this point, I will turn it over to Talia for any questions and answers that you might have.
Thank you, Deloise and Donna, for such a great and informative session today. We will now be taking just a few questions with the time we have left. If you have a question, please use the Q&A box at the bottom of your screen to submit your question. If your question does not get answered during the session, someone will follow up with you after the conference. With that, let's get to a question. How do I know who my assigned foreclosure rep is? Deloise, I think that's for you.
Thank you, Talia. Every size portfolio has a foreclosure representative, and you can send an email to foreclosures@freddiemac.com, and we will be able to put you in contact with that representative. We look forward to hearing from you.
Perfect. Thank you. That's all the time we have for questions today. If we did not get to your question, we will follow up with you after the conference. Your opinion is important to us. Please take a few moments to take our brief survey so that we can continue to bring you timely and relevant content. You can also log in at any time after the conference to play back this or any other session. Thank you and enjoy the rest of the conference.
Hi, everyone. I'm Tim Kitt, Single Family's Head of Pricing and Execution. We want to thank you all for attending the 7th Annual Connect Conference. It was so great to see so many of our industry partners again in this virtual platform. As we stated at the start, we hope you're leaving with new ideas, new skills, and a whole lot of momentum to advance the work that you're all doing to make this industry even stronger. Thank you for joining us and for making the event a success. We shared with you the insight into the regulatory environment from our fireside chat with FHFA's Director, Sandra Thompson, and our own CEO, Michael DeVito. We're all very excited by her enthusiasm and her commitment to expand our mission to make home possible. A huge thank you to our sponsor partners, both our title and premier sponsors. This event would absolutely not be possible without your support. Our theme this year is the power of two, helping you to successfully grow and manage your business. Our goal was to provide you with better insights that will lead to better business outcomes, and we really hope that we've succeeded in this regard. Please help us make next year's Connect conference even better by completing the post-event survey, and we all look forward to seeing you again next year. Thanks so much.